Hello, my name is Kyle McClain, and I'm a partner and senior wealth manager here with Ram & Gorell Wealth Management. Today, we're going to be talking about early retirement distributions, specifically those allowable under IRS Section 72T, as well as the Rule of 55. If you or someone you know could benefit from these strategies or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. The IRS has historically forced retirement savers to wait till age 59 and a half to start withdrawing assets from their IRAs or employer-sponsored retirement accounts without penalties. These restrictions were put in place to incentivize long-term retirement savings and generally deter withdrawals during your working years. However, many individuals find themselves financially ready to retire before age 59 and a half. What many investors don't know is that there are various rules that allow them to withdraw funds from their retirement accounts before 59 and a half without incurring any penalties. Some of these rules are for major life events, but there are two that are clearly oriented towards individuals who wish to undertake early retirement: IRS Section 72T and the Rule of 55. IRS Section 72T allows individuals to take penalty-free distributions from their qualified retirement accounts before reaching the age of 59 and a half. Under this rule, participants must commit to withdrawing periodic payments for a minimum duration of 5 years or until they reach the age of 59 and a half, whichever is longer. To avoid a tax penalty, these distributions must be considered substantially equal periodic payments by the IRS. Individuals must choose one out of 3 IRS-approved methods to determine the amount of these substantially equal periodic payments: the required minimum distribution method, the fixed amortization method, and the fixed annuitization method. Each of these methods uses the IRS's Uniform Lifetime table to calculate annual distributions based on the life expectancy of the individual, the account balance of the individual, and other factors. The RMD method often yields the lowest annual payout, while the fixed annuitization method often results in the greatest annual payout. Once these substantially equal periodic payments commence, individuals must continue taking the calculated payments for the predetermined period, regardless of their financial circumstances. Discontinuation of payments before the minimum duration has elapsed can result in retroactive penalties for the entire period. One item of note: investors are also able to use the calculation on one specific IRA rather than being forced to consider all of their IRA assets for the calculation. Additionally, in some cases, individuals may change the calculation method without ceasing distributions or violating the rule. While the 72T tax rule waives the early withdrawal penalty, distributions taken under substantially equal periodic payments are still subject to ordinary income tax from traditional IRAs. It's also worth noting that withdrawing funds from retirement accounts earlier than planned can significantly impact long-term savings goals. It's important to carefully consider your specific situation with a financial professional, such as our team, before pursuing this strategy. The Rule of 55 applies only to retirement savings in the employer-sponsored plan associated with the employer from which the individual most recently separated. This means that if the individual gets another job and is covered by a new 401k plan, they are no longer eligible for Rule of 55 distributions. Similar to the 72T strategy, distributions will still be taxable in the year that they are taken. Please be aware that there is a mandatory 20% tax withholding on Rule of 55 distributions. And unlike 72T, the Rule of 55 does not require a certain amount to be withdrawn every year. Now let's break down some of the key differences between the Rule of 55 and 72T. 72T payments can start at any age prior to reaching age 59 and a half, while the Rule of 55 allows penalty-free withdrawals at age 55 or later. While Section 72T applies to all types of qualified retirement accounts, the Rule of 55 exclusively pertains to employer-sponsored retirement plans like 401ks and 403bs. The Rule of 55 offers more flexibility, as individuals can take one-time payments or take periodic withdrawals as needed, subject to employer rules on the plan. 72T, alternatively, necessitates consistent, predetermined withdrawals for the entire duration of the commitment period. Both 72T and the Rule of 55 allow taxpayers to access their retirement savings penalty-free prior to reaching the age of 59 and a half. They each have different rules that govern them, and if executed incorrectly, can result in adverse tax consequences for the taxpayer. Investors should carefully consider how these rules work, as well as their advantages and common pitfalls before deciding which option is best for them. We recommend consulting a financial professional before transacting any of these strategies. At Raymond Gorell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or simply visiting our website today.